Right now, the exact financial habits that made you money in 2024 are the ones silently bankrupting you in 2026. The rules just changed, the Fed is pivoting, and if you don't stop doing these five things immediately, you're screwed. Look, I am going to be brutally honest with you. The financial playbook you relied on for the last 2 years is entirely dead. We're sitting in April 2026, and the tectonic plates of the global economy have shifted right under your feet. The Federal Reserve just paused their rate cuts last month, pinning the benchmark interest rate at 3.50% to 3.75%. Meanwhile, the S&P 500 is ripping past 6,500, yet flashing massive, flashing red warning signs we literally haven't seen since the absolute peak of previous market crashes. I'm going to tear down the five toxic money habits you need to stop doing immediately in 2026. Every single one of these points is costing you thousands of dollars in lost opportunity. And I promise you, point number three is going to make a lot of people violently angry, but it might just save you from the biggest financial trap of this decade. Let's get into it. One, stop treating high yield savings accounts like investments. Back in 2023 and 2024, you felt like a financial genius, didn't you? You parked your cash in a basic zero risk savings account and collected an effortless 5% yield. It was a golden era for lazy money. But wake up, it's 2026. The easy money party has been violently shut down. Following a string of rate cuts last year, the Fed just held the federal funds rate steady at that 3.50% mark as they monitor geopolitical tensions in Iran and volatile oil prices. What does that macro level shift mean for your wallet? It means commercial banks have rapidly slashed the APY on your savings account. Right now, inflation is stubbornly sitting around 2.4%. When you factor in the taxes you are legally obligated to pay on the pathetic interest your bank is giving you, your real return, your actual spending power, is basically zero. You are running on a treadmill at maximum speed just to stay in the exact same place. I see so many retail investors hoarding cash right now because they are terrified of market volatility. They read the headlines about global conflicts, they see the market swinging wildly, and they panic. They think cash is a safe harbor, but in 2026, cash is a melting block of ice. 2. Stop blindly buying the S&P 500 dip. Okay, before you furiously type a comment saying, I am going against the golden rule of investing, hear me out. I'm not telling you to stop investing in the stock market. I'm telling you to stop buying the market completely blindfolded. In April 2026, the S&P 500 is surging, recently crossing the 6,528 mark in a massive rally. Wall Street is popping champagne, but if you look under the hood, the engine of this car is smoking. We are currently seeing the Shiller-Cape ratio, which is a heavily relied upon metric that measures how expensive stocks are compared to their actual earnings, hitting near 40. To translate that from Wall Street jargon to plain English, stocks are more expensive right now than almost any other point in the last 150 years. If you're buying a standard market cap weighted ETF like VOO or SPY right now, you aren't really buying 500 diversified companies. Because of how dangerously top heavy the market has become, you are basically dumping a massive chunk of your life savings into just a handful of massive tech giants. If even one of those mega cap tech companies misses an earnings report, your entire portfolio catches pneumonia. But this popular ETF strategy is actually a trap. And remember that open loop I teased earlier? Here's the exact solution you need to implement. 3. Stop waiting for the mythical real estate crash. This is the one that is going to upset people, but my job isn't to make you comfortable, it's to give you the data. For the last 4 years, I have heard the exact same excuse from people sitting on the sidelines. I'm just going to hold my cash, wait for the housing market to crash like it did in 2008, and then I'll buy a mansion for pennies. I need you to look at the macroeconomic math and stop operating on emotion. We are in 2026. The 2008 crash was caused by predatory subprime mortgages, banks literally giving $1 million variable rate loans to people with no verified income and no jobs. That is fundamentally not what is happening today. Today, we have a massive structural lack of housing supply, combined with millennials and Gen Z hitting peak household formation age. On top of that, baby boomers are refusing to sell their homes because they are locked into 3% mortgage rates from 2021. The inventory just isn't there. And what did the Fed just finalize? They stabilized the base rate near 3.5%. Mortgage rates have found a new permanent baseline. They aren't going back down to 2.5% anytime in the near future, but they also aren't choking the market at 8% anymore. If you are waiting for a 30% catastrophic drop in home prices, you are going to be renting for the rest of your life. Institutional investors, private equity firms, and massive corporations are still systematically scooping up single family homes. While you're sitting in your apartment waiting for a crash that isn't coming, your rent is going up, your purchasing power is being destroyed by inflation, and the exact home you wanted to buy just appreciated another 5%. Stop trying to time the real estate market. If you plan to live in an area for more than 5 to 7 years, if you can afford the monthly payment without eating instant noodles every night, and if the numbers make sense for your personal budget, buy the property. The absolute perfect time to buy a house is when you are financially ready. Stop trying to outsmart a market that has infinitely more capital than you have patience. 4. Stop falling for turnkey, AI, passive income scams. If I see one more targeted ad from a 19-year-old in a rented sports car telling you how to make $10,000 a week passively by having an AI write ebooks, generate drop shipping store descriptions, or mass produce faceless YouTube videos, I am going to lose my mind. Let's look at the harsh reality of the 2026 tech landscape. Artificial intelligence has officially transitioned from a cool, novelty internet trick to a completely integrated baseline enterprise tool. The massive financial institutions, the tech giants, and the Fortune 500 companies have embedded AI into their core operational workflows. The era of easy, low hanging AI fruit is entirely gone. You cannot just prompt a chatbot, slap the output onto a digital storefront, and expect to build a sustainable business. The internet is completely saturated with AI generated garbage. Because supply is virtually infinite, the financial value of purely digital, low effort content has plummeted to zero. So, where is the money actually moving? Stop trying to use AI to replace hard work and start using AI to amplify high value, undeniable skills. The people making real generational wealth in 2026 aren't selling AI generated art. They are learning how to manage complex data system architectures. They're entering physical businesses and trades which AI literally cannot touch, or they are building deep relationship based service companies. 5. Stop ignoring alternative and private markets. For decades, the standard untouchable financial advice was the classic 60/40 portfolio: 60% invested in public stocks, 40% invested in bonds. You set it, you forget it, and you wake up comfortably rich when you are 65. But in the high velocity macroeconomic environment of 2026, the 60/40 portfolio is fundamentally struggling to keep pace. Wall Street knows this. That is exactly why the biggest institutional money managers and sovereign wealth funds on the planet are flooding billions of dollars into private markets. I'm talking about private credit, venture capital, and exclusive private real estate funds. Historically, you had to be an accredited investor, meaning you needed millions of dollars in net worth or a massive yearly income just to legally access these alternative investments. The ultra wealthy had a VIP section of the economy where they generated massive yields, while retail investors like you were stuck fighting for scraps in the highly volatile public stock market. But 2026 is the year that institutional wall officially collapsed. We are currently witnessing a massive industry wide trend of tokenization and the true democratization of financial markets. Major platforms and digital brokerages are now legally offering retail investors fractional access to high yield private credit funds and institutional grade real estate developments. Now, listen closely. I'm not telling you to take your entire life savings and recklessly dump it into an obscure private equity startup. But I am telling you that if you want to build a bulletproof portfolio over the next decade, you absolutely need to expand your horizon beyond just your standard 401k and Vanguard index funds. You need to start researching and allocating a calculated percentage of your portfolio to alternative assets that don't move in the exact same direction as the S&P 500. When the public markets get wildly unpredictable, like they are right now with Middle Eastern conflicts and evolving Fed policies, having money anchored in private, less correlated assets is the ultimate shock absorber for your net worth. The wealth gap in 2026 isn't just about who has more money, it is entirely about who has the most up to date information. The fundamental rules of money have changed. The strategies of 2024 are obsolete. You can either adapt your portfolio to the new reality, or you can get left behind paying the bill for everyone who did. Don't just watch this, nod your head, and blindly scroll to the next video. Take 15 minutes today. Open your banking apps, look at your brokerage portfolio, review your housing plans, and brutally audit yourself against these 5 points. Protect your capital, upgrade your strategy, and execute.